In real estate, you've probably heard location, location, location. And what does that usually mean? If we're a local investor, that usually means, hey, the best neighborhood in our town, maybe the best street, maybe the best house on the block, whatever that may look like. But now, once you get into this world of passive investing, you can look beyond your backyard, right? As a passive investor, we have the ability to, the world is our playground, right? We can invest anywhere in the United States, we can invest anywhere in the world as a passive investor. So that's one of the big advantages of being a passive investor, is that you can participate in many different geographical locations and regions. You're not stuck to one place. We got a very great guest here. His name is Zack Haptonstall, and he's CEO and founder of Rise 48. I'm going to let you kind of tell a little bit. I don't want to butcher it, but he's built an incredible business, right? They built an incredible business. They have 240 full-time employees, and they have $1.6 billion with a B, billion dollars worth of multifamily real estate assets under management. And they've been huge players in 2 markets that they concentrate in, right? So now those are Phoenix and Dallas, right? He started in Phoenix. I'm going to let him talk a little bit about it. But this is a guy that obviously understands markets, and he picks a place and goes all in there, right? So I really want to pick his brain a little bit about how he chose the markets that he's in, or the places, cities, and places that he invests. And they've done very well, this company. So they know a little thing or two about picking properties in the right markets and right sub-markets. So today's topic, we're going to talk about the top 5 things to look for when you're investing in a certain geographic region. So Zack, thanks for joining us. I'll let you introduce yourself. I gave a very brief intro. I mean, tell us a little bit about yourself and the business and the incredible business you've built.
Yeah, thanks so much, Johnny. You know, I was stopping in the coffee shop this morning to grab a latte, and then saw you sit at the coffee bar, and you want to talk about location. So I figured I'd sit down and chat up. But yeah, no, so really excited to be here. You know, I'm really grateful to be on your show, your platform here, Johnny. And so yeah, I'm Zack Haptonstall, CEO and co-founder of Rise 48 Equity, and all we do is value-add multifamily, like Johnny said. So we've got our corporate office is in Phoenix, Arizona. We also have an office in Dallas, Texas. You know, we purchased 48 different assets, about 9,000 units. A little over $2 billion worth of transactions. We've gone full cycle and sold 11 of those projects and been able to achieve really strong returns for our investors. And, you know, a big reason why is exactly what Johnny was talking about, is location, right? So I think, you know, everybody knows that cliche, like Johnny said, location, 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 whether it's single family, whatever. But when we're looking at multifamily, you know, we're looking much deeper into location. What does that mean? And we're basically looking for major fundamentals. Okay. So some of the top 5 things we're gonna go over here today. The first one is population growth. Okay, so you want to be seeing that there's a lot of what you call in-migration, meaning that there's more people moving to that area than there are leaving that area. Okay, and it comes down to your simple economics 101 of supply and demand, right? So you want to have more demand of people that need to rent apartments than there is supply, you know, of apartments there. So, you know, we started in Phoenix, and Phoenix was #1 in the country, you know, the last few years for new population growth. You had all these people leaving California, Washington State, Oregon, Chicago, New York, you know, a lot of those types of areas. There's people just, you know, in masses leaving, and they're going primarily to Phoenix, Texas markets like Dallas, Fort Worth, and then Florida, right? That's just the data shows you. You can look at U-Haul data, and it shows you where people are moving. Okay, and so, you know, population growth is a big thing because you need people to be able to rent. And population growth, you know, it's an indicator of other things that are important for the market, right? It typically means that it's an affordable market if there's more people going there. You know, there's a quality of life there. You know, weather is typically better because the numbers don't lie, right? If there's big trends of people going to a certain area, you know, there's a reason for that. And so, you know, population growth is the first one, right? You want to have in-migration. And when we looked at Phoenix, obviously we were fortunate to be in Phoenix. There were so many people coming there. Phoenix is the 5th largest city in the country by population. Most people don't realize that. Okay, so it's basically Los Angeles, New York City, Chicago, Houston. Phoenix is number 5. Okay, and so when we were looking for our second market, we said, okay, where are people going? And we said Dallas, Fort Worth. Okay, DFW. You know, it's where there's all these people going, and it's a major factor what we're looking at. So first thing is population. The second thing, you want to see job growth, right? Because we need these people. You know, to kind of simplify it all, these tenants or residents that support the investments that, you know, all of us on this call invest in passively or actively, they go to work, they get a paycheck, they pay their rent. That rent covers the operating expenses, the debt service, and whatever's left goes to you, the passive investor, right? So we want to make sure that our residents, who are really our clients, they have good paying jobs. And so we're looking for, you know, job growth markets where there's new companies moving there, and we want to make sure that there's diversified job growth. Johnny's the big thing, right? So, you know, there's different markets across the country may have a lot of jobs, but we don't want them to be too heavily concentrated in any one industry, right? Because those types of markets are not insulated during downturns. So for example, you look at like Las Vegas, it's heavily concentrated in tourism and hospitality. And Vegas has been like a boom or bust market, historically, where it will do really well, but then it can also get crushed. Like it did very poorly during COVID. It's not doing well now. You have a lot of delinquency, just because, there's a lot of people getting laid off, or they don't have jobs, whatever, they're not paying their rent. Okay. And so I think it's easy to assume we're going to buy an apartment building, people are going to move in, they're going to pay their rent. It's not that simple, right? You got, a lot of people that have the financial resources to invest passively. Well, you've typically, gotten a degree, you've worked hard, and you're always going to pay your bills because that's how you are. But a lot of the demographics when you're renting apartments, if they don't have the money, they're not paying the rent. Okay. And then it affects you as the apartment owner, even if you're a passive investor. And so you want to look at markets that have diversified employment and can really weather these downturns. And so, for example, Phoenix and Dallas are actually some of the most diversified. So believe it or not, Phoenix had the lowest job loss rate in the entire country during COVID. It actually did very well during COVID. When we look at it, what we do, Johnny, is we're looking at markets. Like when we decided to go into DFW, Dallas-Fort Worth, we pulled data from the U.S. Bureau of Labor Statistics, okay? And they have charts. So this is basically the federal bureaucracy of labor. And they have charts for every major city that shows the concentration of the industries of the workforce. Okay, and so it'll show you like trade, transportation, utilities makes up X%. It'll show you financial services, healthcare, technology, things like that. So we want to make sure that we're looking at markets that have that diversification as far as the industry, and there's not too high of a concentration. One thing we look at, the U.S. Bureau of Labor Statistics, they have one category. Some of these categories have multiple industries in them, but they have one category called mining, logging, and construction. Right? We want to make sure that number is low, because whenever there's an economic downturn historically, those construction jobs dry up and they go elsewhere. It's just the nature of the industry, right? So you do not want to be heavily concentrated in construction. So like in Dallas and Phoenix, I believe they're both like 6% or lower is mining, logging, and construction. It's a small percentage. Even you look at a market like Houston, has a high concentration of oil and gas. So Houston can do well, but you got to be aware of oil and gas because sometimes that can impact it. So you just want to look at these different things. So population growth, number one, job growth is the second thing. And these aren't necessarily in order of importance, but it's the top 5 I'm going through that to be aware of. And it sounds simple, but you need people to live in these apartments. You need people who have jobs so they can pay the rent, right? But there's things that you can look at, and you even want to go down into the submarket. And we're not going to go super deep dive on this coffee meeting that Johnny and I are having. We're going to kind of just brush over the 5 topics. So I think we'll go deeper on another call. But in the future, we can go deeper into actual submarkets where you want to kind of dive deeper into that. So job growth, population growth. Number 3, you want to look at median income. Okay, and so this is actually where you get a little bit more granular into submarkets, because any of you who live in a big city or a big market in the U.S. can attest to the fact that there are pockets throughout that city, right? There's good areas, there's bad areas. So in general, Phoenix is great. In general, Dallas-Fort Worth is great, but there's rough areas in every major city. And so you want to be looking at median income, okay? Because that gives you a good indication of what types of jobs are in that immediate area. And you want to look at like 1 mile, 3 mile, 5 mile median income. So whenever we're looking at a new deal as part of the underwriting process, we'll look at the 1 mile, 3 mile, and 5 mile median income. We want to make sure that the average rent that is at that property is supported, as a certain ratio of what that income is. Okay, so typically we are qualifying tenants. They have to make at least 2.5 to 3x the monthly income of what the rent is. Okay, so typically you want to see, hey, that median income is 3x of what that rent would be. Okay, that annual median income. And sometimes it's hard to gather that because most of these data sources are using U.S. Census Bureau data for median income, and a lot of it can be outdated. Whenever the last census was, so you have to try to pull it from different places. But in general, when you're looking at a property, you want to look at what are the major employers nearby, right? And then what, are those higher paying jobs, or those, they at least workforce housing type of jobs that are good enough to support that demographic. Okay, so median income is a big thing because it's going to give you an indication of, are these people going to pay the rent? You're going to have lower delinquency when you have higher median income. And this is just statistically, okay? This may not be politically correct, but statistically, you're typically going to have less turnover, less crime with higher median income demographics. That's just the reality, okay? And so that's the third one, median income. Fourth thing kind of leads me into that transition, crime ratings, right? You want to look at crime ratings. So there's a few different sites that we look at. Every time we underwrite a deal, by the way, we're looking at these things, okay? Because you have to look at the actual submarkets inside these bigger markets. What type of neighborhood is it? And so there's a site we like to use called bestplaces.net. And they give you a crime score, okay? And so basically it takes actual public record, any of the events that have happened there, and you can make it like the last 3 months, 6 months, 12 months, 24 months, whatever, but we're looking at crime scores, okay? And there's always a correlation. When there's lower income, there's higher crime, okay? So you're looking for higher income, lower crime, because in your underwriting model, you might go buy a deal at a really low price per unit and a really high cap rate. Like, this is a home run, right? But typically, the higher the cap rate, the higher the crime rating. Okay, there's a reason why you're getting that deal for cheaper, because you're going to assume all these numbers are going to work in your model, and you take that property over, and when those tenants aren't paying the rent, when there's crime and people don't want to go rent at your apartment because it has a reputation, when it's getting run down, when you're having to evict people constantly, you don't hit those projected numbers. Okay, so we specifically have said, and this kind of ties into the whole macro topic here, is that, for example, we're in Phoenix, right? And again, this is all my personal opinion. So I'm not here to bash any market specifically or any operator who's in a specific market. I'm just giving you our own philosophy. I'm not saying I'm an expert. It's just how we do it. Is that a lot of people have said, for example, hey, why don't you guys go to Tucson? You know, Tucson, you can get a lower price per door, higher cap rate. It's only like an hour and a half south. And I've lived in Phoenix my whole life. I want nothing to do with Tucson, okay? Because Tucson does not have a lot of jobs. There's higher crime. It doesn't have the growth. I would rather pay a higher price per door and know that I'm in the heart of a major metro, which is insulated with jobs, population, things like that. Okay, so I mean, same with Dallas Fort Worth. We're not going to go to tertiary markets. We want to be in the heart of Dallas Fort Worth, where all the people are. Okay, we don't want to be going further and further out. And you could go to a ton of tertiary markets in Texas, but I want to be where all the jobs are, where all the people are, and then obviously I want to be where there's lower crime. Okay, so that's kind of the fourth thing, is the crime rating. And then fifth thing, Johnny, is, and this is something we really, everybody needs to be paying attention to the last 12 to 18 months, because I think people kind of forgot about it, is new supply of apartment units in that area, right? And we've seen it in Phoenix. Okay, so you know, according to RealPage, 2023 there was more new supply of apartment buildings hit that were delivered, meaning more new build apartment units across the entire United States were delivered in 2023 than any year since 1985.
Yeah,
okay,
a million units, right? Like a million units.
Yeah, it was something like crazy like that. Yeah, it's crazy. And to give people an idea, that is the residual effect of all the new build apartments that were being built, like mostly 2019 through for first half of 22. Okay, they all started to deliver. Really 2019 to 2021. They started delivering in 2023. And so you got flooded with all this new supply. And in Phoenix, for those of you who understand the Phoenix geography, most of it in Phoenix is like in the West Valley to the Southwest Valley. Okay, well, we have like 3 or 4 properties in Southwest Phoenix area, which is it's been a good submarket. But what happened is all these new apartments came online, and the cost to build new apartments the last 3 to 5 years has been so high. The only way to make those new build apartment projects work economically is that they have to command very high premium rents to make their investment project work. Okay, so when those things got delivered, they have these really high rents, and at the same time, inflation caught up to people. Okay, and so it's like last year in 2023, what you saw across the country, okay, and we saw it in Phoenix especially, is that inflation caught up to people, meaning that their gas costs, their groceries, everything is higher, and at the same time, there was all this COVID money and unemployment money that was kind of being pumped in the system. It all just really stopped last year. And then you have all these new apartments coming online, these new apartments with these premium rents. There's a very small demographic of people that can afford that, okay? And the people that can afford that, they're making the decision, do I rent this Class A apartment or do I go buy a house? You know what I mean? And so what these new apartments have had to do is give 2 to 3 months free rent. They have to give these massive concessions because they just built this 300 unit building. They have to lease it up and they can't get people in there. So they have to give away the farm to start leasing that thing up. And so what happened is with our properties was that the properties that we have that are kind of close to those new supply, new development deals, tenants that are like B-class workforce housing tenants that could have never afforded Class A are moving into Class A because they're getting 3 months free, right? And it's starting to make us have to offer concessions. Like we had to give up to 4 weeks free on some of these deals because everybody around us was doing it, kind of undercutting each other. And this happened across the country. Like all the major markets, you saw this. And it's just funny because, you can get into all these complex underwriting metrics, but at the end of the day, it kind of came back to that economics 101 of supply and demand, right? It's like there's more supply and it wasn't getting absorbed fast enough. And so now we learned, like when we're looking at submarkets, we're looking at supply pipelines, making sure that there's not a ton of new builds hitting that immediate area. And you're looking at in-migration numbers to make sure that those new units can get absorbed. And give people an idea, that supply is supposed to fall off a bit this year and then significantly in 2025, 2026, because across the country since summer of 2022, when interest rates started to skyrocket, all the projects stopped. Yeah, the interest rates skyrocketed, like Johnny said, and all those construction projects just paused, or those construction loans blew up. So there literally hasn't been any building. I shouldn't say literally, but there's hardly been any building the last 18 to 20 months. Okay, and so people are saying the residual impact is by 25, 26, there's going to be a shortage of housing. Okay, so a lot of people are projecting a lot of organic rent growth is going to come back in these major growth markets. And so, I mean, a lot of people, if you're newer to this the last year or two, kind of being part of Johnny's group, then you may not realize this, but like the last 5 to 7 years, call it 5 to 8 years, the growth markets were the big markets where people were going. Phoenix, Dallas, Tampa, Orlando, Atlanta, the Carolinas. Yeah. Mm-hmm. Right, exactly. That's where people were going. That's where you have all this organic rent growth, right? Well, like the last 12, 18 months, it's like the opposite has happened where the big markets have started to have trailing back organic rent growth. In the Midwest cities, these little cities that were always kind of like steady Eddie, no growth, are seeing growth in the short term. That's because there's not a lot of new supply in those small markets in the Midwest, right? Like a Columbus, Ohio, Indianapolis, Memphis. These were not good growth markets. These were.
I was wondering why rents were going up in those places. Like, oh yeah, we're getting like major growth. I'm like, how? I don't understand why.
So it's the exact opposite. It's all about supply and demand, and it's going to flip back. Okay, so right now it's because there's people still kind of moving there, but they don't have a bunch of new supply. Like these hot markets where everybody was going to, these have the best fundamentals and they will continue to long term. But that's why everybody started building there. Okay. So like all these developers and investors are like, hey, Phoenix, Dallas, Tampa, Orlando, you know, whatever, all these places, Atlanta, they want to go build there because it's a hot market. Well, then you get flooded all with this new supply at the same time. Inflation kind of really caught up to people. COVID money kind of runs out. And so you have like this 2-3 year window where you're going to see those rents come down. But once people are not stopped going to those markets, they're still top 5, top 10, you know, for new population growth. And so it will get back to where it was. It's just a matter of you have to have that supply fall off. But when we're looking at sub-markets, we want to make sure what is the pipeline, and you can typically get that data. You know, what are the construction projects?
I think you should define you know, what a market is and what a sub-market is. I mean, I think that that'd be helpful as well, you know, for a lot of the people.
Yeah, good question. So, okay, so like for example, in Dallas, people will call it the Dallas-Fort Worth MSA. Yep. Okay, MSA means like the market, basically the macro market. Well, that's a humongous geographical, you know, area, Dallas MSA. So you've got, you know, Arlington, Louisville, Bedford, all these other, you know, cities that are part of the MSA. Just like those of you familiar with Phoenix, people will call Phoenix the entire valley Phoenix, but in reality, it's Phoenix, Tempe, Scottsdale, Mesa, Gilbert, Glendale, right? So these are submarkets. These are cities within the macro MSA. And then like, you know, and depending on a submarket, like CoStar RealPage has their own boundary definitions, right? They might call it like North Phoenix, South Phoenix, East Scottsdale, whatever. So you need to kind of understand when you're looking at a market, you know, and that's the operator's job, right? But as a passive investor, you need to make sure that the operator is looking at all of these things, because you can't just say, I'm going to invest in Phoenix and it's hit a home run. Because if I'm in a ghetto part of Phoenix, you know, with really bad demographics, that deal's not going to do well. So you want to make sure that you're looking at, you know, what is the job growth there? What are the major jobs nearby there? You know, what's the crime rating? Is there a bunch of new apartments going there? Because I can tell you, our properties in Central Phoenix, in the East Valley, are doing a lot better than the properties in the West Valley in the short term. That's because there's all this new supply. You know, these 3 properties we have in the West Valley, right? And so that's something we've learned from experience. And I mean, our average occupancy in Phoenix right now we have almost 6,000 units, is 96%. And we're still like last year we renovated almost 2,000 units. Our average rental increase was over $450 a unit, which was still $20 above our initial projections. Okay, and that's when Phoenix had negative 4% organic rent growth last year. But that's why Johnny and I,
that's a value add, right? That's a value. So you control the appreciation there. You're not dependent on the market. Even if it goes down, you still make money, right? So, but 4%, that's pretty significant. I didn't know it was that much. I knew that it maybe flattened or it was down.
Yeah. But keep in mind too, Johnny, the last few years prior to that, it literally went up like 30 to 40%.
Yeah.
Number one in the country.
It overshot the equilibrium.
Exactly.
Right?
So you got like a baseline, it shoots up 30 to 40%, and then it comes back down to just 4%, a little bit back to like, so it shows you the market's still strong, but it can't maintain it, right? But to your point, value add B-class housing has been performing the best because like Johnny said, we do this because we don't rely on organic appreciation. We force the appreciation. We say, okay, there's a property here. And this is what we do even today when we're finding new deals. There's a property here where all the properties nearby have rents that are $200 higher. If I renovate to that level, then I know I can push my rents $200 and force the appreciation by providing a higher quality product for that resident. And they're going to pay it because it's already being proven out in that immediate area, right? That's how we increase the value. That's how you can kind of fight back against new supply, interest rates, things like that. But yeah, I mean, those are kind of the 5 things, Johnny, that we talk about: population growth, job growth, median income, crime rating, and then new supply. Those are kind of the key factors that we're looking at when we're looking at these markets and these submarkets.
Yeah, that's great. Thank you for that, man. That was very insightful. You know, looking at even, you know, all these big population growth, job growth, submarket. So like, let's talk a little bit about the markets, right? MSA, what is it? Metros, statistical area, something like that.
Something like that. Yeah. Good job.
Yeah. So, yeah. Now within that, right? Like Phoenix is a great city to invest in. And like you said, there's areas even within Phoenix, even if the population's growing overall, there's still submarkets, still areas within it where the population is decreasing, right?
Correct. Yeah, exactly. They're not going to the crappy places, they're going to the good places. That's why we have to kind of get deeper in.
Yeah. So you got to kind of look at it. So you can't just say, okay, well, I invested in a property in Phoenix or I invested in a property in Dallas, right? Are you in Arlington, right? Which is, you know, a great place, or if you're in, you know, Tempe or any of these are the kind of submarkets that, and like you said, the operator is really who's responsible for thinking about all of these things, right? But
that's right.
From a passive investor perspective, it's, hey, look, at least having the wherewithal to know what to look for, right? Like hey, I never heard of Rise 48, I never heard of these guys. I want to look at, and I got this deal that they have, and it's located in X ABC submarket.
Right.
You can kind of do if you want to, you can go in, and some of our guys do this stuff, Zach. Like some of our investors are even they're dentists, but they're very savvy real estate entrepreneurs and investors. So some of these guys do go, you know, deeper into the due diligence, and so these are some of the things to consider.
Yeah, no, 100%. You're exactly right. Go ahead, Johnny. Sorry.
Go ahead.
Yeah, I was going to say, like, to your point, we start macro and we say, okay, we want to be in the big markets that have good job growth, population growth. But then we say, okay, I'm going to pick Dallas, or I'm going to pick Phoenix. Then it's like, where in that MSA do we want to be? And that's where you have to get more micro for the submarket, which is median income, like 5-mile median income, right? And then the crime score. That's more that micro stuff, because that'll give you an idea of that area, that neighborhood. And honestly, the big corporations across the US, they're not stupid, right? And what I mean by that is, if you're looking at a property, just go on Google Maps and start looking at the companies in the retail around it. If there's like a Whole Foods, if there's like a bunch of Amazon distribution centers, Costco, all of these places have spent millions of dollars on research and development of areas and demographics. If you notice, when I'm driving through Dallas, every time I see a Starbucks, there's like a Chipotle right next to it. And I swear, one of them's just following each other. Like if there's a Starbucks, Chipotle's putting one up, because they're like, okay, Starbucks knows that this is a good area. And so that's what we look at too, is like, it sounds simple, but it's true. Like, look what's around there. We buy a lot of deals that have like Amazon distributions there, big. The good thing about Dallas that we like a lot is that they call it the headquarters of headquarters, where you've got like more national and international companies with their headquarters there than pretty much any major market, because it's smack dab in the middle of the country. There's all these national headquarters, which means you have a ton of jobs. Okay, so you got like Southwest Airlines, AT&T, Goldman Sachs has a huge thing there, Fidelity. They've just got all these massive companies, which has thousands and thousands of employees at that location. Okay, and those are our residents. Those are the tenants, because they need housing, right? And so these are the things that you look at and kind of get a good idea. And ultimately, obviously, we also drive the properties and shop all the comps, right? So if the comparable properties in a 3 to 5 mile radius are kind of crappy or run down, it gives you an idea of what that demographic and area is like, right? And I tour every single asset that we make an offer on or go to buy. We do a full due diligence, everything like that, and you drive the area. And so yeah, these are all the things. But as a passive investor, these are the things you should be looking at. Like Jonny said, we actually have a ton of dentists as investors, and so there's like some, the dentists they know multifamily is the place to be. But yeah, I mean, I think you should be asking the operator as a passive investor, or the operator should be providing you this information so that you guys can kind of make an informed decision.
Yeah, that's great. You guys, drop a fire emoji for Zack if you got any value out of this. I know I sure did. I learned a ton here. So Zack, we were talking about this offline. We're gonna do a webinar, right? So where we're going to go deep into this, right? So Zack kind of talked from a high level top 5, but we're gonna do a webinar and go deeper into the topics of market. We'll flesh it out exactly what that's gonna look like, Zack. But
yep.
Yeah, stay tuned to that. We're going to see a lot more of Zack here. We're going to, he has a lot of stuff that he can teach us, obviously, with a couple $1 billion worth of experience. So,
I'm just waiting for my latte, man. I don't know what they're doing back there. Yeah.
We came to the smoothie shop, guys. We haven't had a smoothie yet.
I know, right?
Anyway, Zack, thank you so much for being here. We're going to be doing business with Zack, so we will. You do 506C 506B offerings predominantly, right? Like,
correct. So 506B.
This is So if you're interested, schedule a call with me. We can talk about it. We can get that introductory call out of the way for 506C. Now to differentiate, I know I put deals up on here, Facebook. Any deals that we do with Rise 48, with Zack's company here, they're 506B, so we won't be publicly advertising the deals at all, because and we must have a pre-existing relationship. For all the investors and people that have already scheduled a call with me, had a call with me, you guys are good. You guys will see these anytime we have a deal and we partner with them, you'll get automatically on our email list, you'll get it. But if you haven't scheduled a call with me yet, this is a great time to go ahead and do that, so we can knock that out of the way, for compliance purposes, and just establish a relationship. And then we can talk about deals after that. Zack, thank you again, once again, and we'll see you on another episode.
Thanks so much, Jonny. Thanks, everybody. Appreciate it, guys. Talk soon.